Hi, this is James Zhang, and you're listening to the Passive Investor Show.
A lot of investors I partner with have one major challenge. They are busy professionals that love to create memories with their families, but are too busy to actively look and find value-add real estate that cash flows. Hey guys, I'm John Fortes, and I want to partner with you. I provide investment opportunities through apartment syndications that allow my partners to invest passively so they don't have to worry about trading more time for money. If you are interested in creating passive streams of income, wealth creation, and all the tax benefits that come along with investing through real estate, I encourage you to fill out the form at www.investwithfortes.com. Invest today so that tomorrow you can trade money for time. Once again, that's www.investwithfortes.com. And I can't wait to partner with you.
Are you a busy professional looking to diversify your portfolio? Ever wanted to passively invest in real estate but don't know where to start? John Fortes provides you with a guide to passively invest in real estate. This is the Passive Investor Show.
And now, the Passive Investor Show. Here's your host, John Fortes.
Hello, PI listeners. Thank you for lending me your time today. Welcome to the Passive Investor Show. I'm John Fortes. Our goal is to provide you, the busy professional, with passive investing tips and tricks for your real estate investments to leverage more time for you to focus on your true passions. Let's get to work. Welcome, PI listeners, to the Passive Investor Show. I'm John Fortes. Our goal and purpose of this show is to be a resource to passive investors and to help them master their investments in real estate funds. Today's guest is James Ang, born and raised in Houston, Texas, studied finance at University of Texas in Austin, lived in Dallas, Texas, Fort Worth since 2006, background in risk, sales, and investing, risk as an underwriter for 8 years at GE Capital Real Estate, underwriting $750 million in commercial real estate loans. Sales originated over $800 million in multifamily loans across 125 properties since 2015. And an investor, invested as a limited partner in over 7,000 units across 25 multifamily properties in Texas. I like where you go with that, man.
You got it, John. I mean, I tried to make my bio not as boring. I tried to make it like, all right, what's my background and what do people care about? Because sometimes I'll get bios and it's like paragraphs upon paragraphs about like every place they've ever worked, everything that they've ever done. And so I like giving people sort of that snapshot of, sort of born and raised in Texas, and then essentially finance, risk, investing is my background. So if you want to talk to me about other stuff, we can definitely talk about other stuff, but that's my sort of bread and butter stuff.
Awesome. So normally we do a TLDR, too long didn't read, and let you just break it down. But since yours was so short,
Sure.
I just read it off right there. So
okay, perfect.
How did we get from risk, sales to investor? How did you transition into those?
I mean, it was pretty simple, right? Back in, I would say probably 2008, 2009, I was sort of like a personal finance junkie. I would read, Dave Ramsey, Robert Kiyosaki, all that type of stuff. And then not really until I was sort of in the underwriting side. As an underwriter, you look at the loan, look at the property, look at the borrower's balance sheet. And I realized that all these borrowers had a huge net worth who are buying these commercial properties. Like it wasn't like when I went to school, my dad was like, hey, you need to do pre-med, right? Because doctors make the most money. And so that's what I did for 2 years, right? And, most people that's what they think of, somebody who's a doctor, lawyer, accountant, stuff like that. But to me, I saw it when I was an underwriter that the people who made the most money were people who invested in real estate. So as soon as I could save up enough money, I started investing in real estate in 2015 and really started in multifamily. And that also came back to my background. As an underwriter, we did all commercial property types. So we did office, industrial, retail, self-storage, multifamily across the nation. And, in the downturn, the last downturn, the 08, 9, 10, we took back office, we took back retail, we took back industrial. The only two things that we didn't take back were multifamily and self-storage. And so when I started looking at investing, I said, hey, what should I focus on? And those were the two obvious ones to me. So I looked at both. And what I found was that a lot of self-storage was harder to get into. There just wasn't as much in terms of a syndication market. And for me, if I'm investing 50 to 100,000, multifamily made the most sense to me. And that allowed me to sort of get into, in 2015, that's what I started doing. So I, essentially every quarter I tried to invest 50 to 100,000 in a deal.
That's awesome. So a couple of things that jumped out at me. You were pre-med and then you were a underwriter. How did you transition into that?
Yeah. So I did pre-med for 2 years. Actually was doing engineering pre-med, and then I dropped the engineering, went to pre-med, and then I dropped the pre-med and stuck in business. So I did finance coming out of UT, and then I did G Capital had a rotational program where you're essentially like a CFO of different businesses. One of the businesses was here in Dallas in their commercial real estate lending business. And so I was working sort of on the finances of a financing business. And I was like, I want to stay here, learn more about real estate. And they said, look, why don't you go over, work on the risk side of the business, because that's where you make or break your money in terms of a bank. And so that's what I did. And so I spent essentially 2007 to 2015 there, until our entire portfolio was bought by Blackstone at that time. So in 2015, I transitioned into my current role as a mortgage broker, originating multifamily loans.
About the origination, what's the importance of that to a passive investor?
In terms of the loan?
Yeah, absolutely.
Yeah. I mean, you have to look at it the way I started looking at investing. Most of the deals that I did at the beginning, I was trying to replace my income with cash flow. And so most of those deals were stabilized deals. They qualified for Fannie Mae, Freddie Mac. So 90% occupied for the last 90 days. It didn't have a huge value add lift, not a ton of CapEx. We weren't, cleaning out the whole tenant. We were just doing a basic, $3,000 to $5,000 a door rehab. So that qualifies for Fannie and Freddie, right? And so when I'm as a passive looking at a deal, that to me is a pretty safe deal. Right? You're going to probably get, 10 to 15% IRR. You're going to get 6 to 10% cash on cash in that range, depending on what year we are. In 2015, it was 8 to 10% cash on cash. And then the last couple of years, it's been 6 to 8%, I would say. And that what I was just sort of call like a straight sort of yield deal. And so my first, I would say 15 to 20 deals were exactly that. They were just, easier deals, not a huge value add lift, but they were safe. And then, so from the loan side, if a deal qualifies for Fannie and Freddie, I feel pretty comfortable. There's usually, most people are getting 7, 10, 12 years on their loan term. So if a downturn does come in, it's not the end of the world, right? Like I don't have a maturity right now this year. Whereas if you get into more aggressive deals, they're usually going to require a bridge loan. Right. So you might be 75 to 80% loan to cost. It might be a 3-year term. And that to me as a limited partner, I'm taking more risk, right? Because if that bridge loan has maturity, in the next 6 months, then you're in trouble, right? Because you're going to have to either refi or sell that deal in the next 6 months, and you might hit a downturn like we just hit. And so that's why I think for bridge loans, you have to get a higher return on that money. And I just finished reading one of Howard Marks' books, and he runs Oak Street Capital. And the way he describes it is there is a lot of times when we look at returns, you only see best case scenario. But the way he looks at it is the further you go out on the risk curve, then the wider range of returns that you could get, right? So on a Fannie deal, right down the fairway, 90% occupied already, limited rehab, that deal might be anywhere from 10 to 15% IRR. But then if you go and do a bridge loan and it's a heavy rehab, they're showing you 20% IRR on the sheet. But then it also could be a 0% IRR, right? So as a passive investor, you have to be aware of that volatility of risk. And I think once I got comfortable with my income sort of being set with enough passive deals that were just, down the middle, then that's when I sort of went further out in the risk curve to try to get higher returns. But if deals start going bad, then those could come back as zero, right? So that's the risk that you take on those deals, because it could go, you put in 100 and they could give you 200 back, or they could give you zero back. And so that's the risk you have to take. And I went out further once I had sort of that foundation of cash flow though.
Oh, I love that. I love how you figured out your lane and you figured it out quickly. And I want you to walk us back to your first investment.
Sure.
Because a lot of times when you're making your first investment, it's pretty scary because you're walking into something you either just learned or you're really confident in,
Sure.
but you haven't been through the process. Can you?
So in 2015, I did my first one, and essentially it's probably 15 minutes away from my house. I could drive there. It was an area that I had lived in for like 15 years. And the person that I invested in, they had worked with me back at GE when I was an underwriter, and they had been doing multifamily for about 5 years already. So they left GE in 2010, started doing this. They're buying 1-2 deals a year. So they already had 5 or 6 deals under their belt. So I was very comfortable with their track record and their ability to buy deals. And they were smarter than me about multifamily. So I was like, look, I'm not going to go out there and buy a deal on my own. So let's try this. So I did 50,000 on that first deal, and they were more, I would say, A- deals. So suburban multifamily, sort of garden style walk up, 1990s construction. And so it wasn't like I was safe driving there. I was fine, going there at night with my wife, like, and getting out of the car, walking around. Like, so it was a pretty conservative deal. And, that deal was probably a 20% IRR deal when we sold it.
That's pretty cool.
Yeah.
How has it compounded in what it is today, your investing business?
Yeah, I mean, I think as, there's probably 7 or 8 deals out of the 25 that have sold. And so those deals, I mean, now my decision is, all right, do I reinvest those deals at the top? So in the last, I would say in 15, 16, 17, I tried to do about a deal a quarter. But then in 2019, I only did like 2 deals. 2020, I did 0. So it slowed down, and it was a little bit of me saying, all right, well, should I be reinvesting in this market right now, or should I be waiting? And luckily I waited a little bit and held back some capital. So now that I think in the next probably 12 months, I don't know if in 6 months we're going to see as much dislocation, but maybe in 12 months there's going to be opportunities to come in and buy at 15, 20% discount to what people were paying, and essentially come in and just sort of reset. I would hopefully get back to your returns that you were getting in 13 and 14 with 8, 10, 12% cash on cash.
That's awesome. So moving forward and going forward with what we're dealing with right now, how confident are you in your investment decisions now than you were before?
Yeah, I mean, right now I have pretty close relationships with my general partner. So I usually, give them a call, or they're sending me updates either weekly or bi-weekly on the properties. And luckily, I would say probably 1 out of the 25 right now are on a bridge loan and have a maturity, I would say, in the next 12 to 18 months here. But everything else has longer term maturity. So that's rule number 1 of surviving a crisis, is not having to sell during a crisis, right? And so most of the other loans are all Fannie Freddie loans, and they have probably 4 to 5 years plus on their loan maturity. So I think you just ride it out. So I don't see much risk in that. So really, I'm just concerned about the one investor or one investment with a bridge loan that matures. I would say I think it's summer 2021. So it was done 2018, summer of 2018, and it was a 3-year bridge. It has 2 1-year extensions. And so I think right now what we're going to try to do is just refi that into maybe a shorter term 5-7 year Fannie Freddie loan and just reset the maturity.
That's pretty cool. So what's one of your practices that you can provide for the first time investor?
I mean, there's so much. I mean, I think like we talked about it a little bit before we jumped on the call, but just having sort of like your investment criteria laid out and you can at first, like, you will not have investment criteria because you don't have any experience, right? But I would steal the investment criteria from people who have a lot more experience than you. So I would, figure out, I would talk to top general partners, and then maybe at the end of every conversation ask, hey, what are your top 3 rules, right? So what are, 3 things that you're not going to go against ever, right? And if you can get those rules from, let's say, 10 general partners, and then that can start building your investment criteria. And every deal is not going to exactly hit that, right? So you might have 30 rules and, you check the box on 27, but those last 3, this one doesn't fit. So at that point, you have to make the decision. Am I okay putting in 100,000 on this deal, even though it goes against 3 of the rules? And so that's what you have to start building. I think that would be a good practice, and that's one that I'm starting to do right now in terms of building my investment criteria.
What's something you learned due to your passive investing background that's really helped you?
I mean, I learn every month, right? So on the 15th to the 20th of every month, I get 25 reports, and almost all my deals are in DFW or Austin or San Antonio, right? And so that's where I lend. That's where I look at deals. That's where I look at potential new deals. And so to me, it's like a constant monthly gauge on where rents are, where occupancy should be. And so I think this is one of the things I liked about passive investing, is that you actually get better as a passive investor over time because you have more inside information than most other people. And compare that to sort of my first 10 years, sort of from 2005 to 2015, I invested in 401ks, Roth IRAs, your standard stock market stuff. But then after 10 years, I was not a better investor at all. I mean, I was just, throwing darts like every other monkey. And I think as a passive investor, though, over the last 5 years, seeing monthly reports, seeing what the operator's doing, seeing what management companies are using, seeing the CapEx that they're doing, that allows me to make better informed decisions. So if I get a package from a general partner and they're like, hey, in this deal, like we talked about the submarket of Irving, we're going to take rents from $1 to $1.20 on this property. And I look at my properties in that submarket and I don't see one property at $1.20 in rents, you're not going to get it. And so I'm not going to invest in that deal. And so that's why I think, but if every one of my properties is at that rent level, and this property you're going to take from $1 to $1.20, I'm in the deal, right? And so as long as you can, I think that's the main advantage of being a passive, is that you get to learn along the way, and you have a little money at risk, but not all your money's at risk.
And today, you still do get excited when you see a new opportunity come across your desk, right?
Absolutely. Yeah. I mean, whether it's a new opportunity as a passive, as an opportunity to do a loan, I mean, I still like when someone sends it to me, whether it's T12, rent roll, or a package, digging into it, I've just gotten faster, right? So when someone sends it to me and they're like, if you sent me a deal right now and then you called me 5 minutes later, essentially I could walk through that deal and tell you where I think the pitfalls are in that deal. And as long as you've addressed those challenges, whether it's with capital, whether it's with management, then I feel comfortable investing in it. And if you can show me that you've done this before, right? Like you have a property down the street that's getting those rents that you're performing, that makes the decision a lot easier for me. Yeah.
So what's one piece of advice for the PI listeners?
One piece of advice, I mean, right now I would say is constant education. Because even right now, I'm starting to like right now, there's not as many deals on the market, right? For buying or in selling deals, right? And so I've spent a lot of time just following other investors and what they're doing, and learning from them. So whether it's Howard Marks, whether it's following there's a newsletter called Pensford, which is on interest rates. There's just great investors, and sort of building out that investment philosophy, I think is a huge opportunity. And to me, you're constantly building out your general partner network and limited partner network. And so whether you're on the GP side or LP side, that's what you should be doing right now.
Absolutely. Pensford's Monday morning email is
Sure.
the one I love to hammer out every Monday. So
Yeah.
James, how can we reach you?
The best way to reach me is probably email. It's jeng@oldcapitallending.com, or my cell. My cell is 214-300-5035. And then I have a couple of websites. You could go to txmultifamily.com. That shows all my deal closings. And then also you can reach me on YouTube or LinkedIn. There's plenty of videos there of all my content.
Go watch his YouTube content. I'm watching it. I love it. Thank you for providing that, putting it out there. James, thank you for coming on. PI listeners, you heard it here. Passive investor. James is a professional passive investor. And guys, till the next episode. Appreciate you. PI listeners, I'm grateful for your time and I appreciate you for listening. For more information, go to passiveinvestorshow.com. If any of this resonates with you, please subscribe and leave a review. The more you know, the more we grow. Thank you for tuning in. Till next time.